Hello everyone, welcome to week 2, lecture 4 of our NPTEL course on metrics and analytics of marketing. Today's topic is profit and profitability metrics. I will be guiding you through this essential concept in the context of business management. By the end of this session, you will understand that profit, what is the real meaning of profit, the key metrics to measure profitability, and how to apply them in real world decisions. We will also delve into a case study of Amazon. We will touch on strategies to boost profitability and common challenges associated with profitability, I mean improving the profitability metrics. When we talk about profit, it is not just about making money. It is the lifeblood of any business. Let's dive into the detailed concept of profit. So, as shown in this slide, profit is the financial gain from selling a product or service after subtracting all associated cost. Simply put, profit is equal to revenue minus cost. What is revenue? Revenue is the total income from sales, while cost include everything from raw materials to marketing expenses. For example, imagine that you are running a small coffee shop. If you sell 100 cups of coffee, let us say price of each cup of coffee is 5 rupees. That 500 in revenue. The total revenue by selling 100 cups of coffee for 5 rupees each, you can collect a total revenue of 500 rupees. But it costs, the cost for the beans, the cost for the milk, the cost for the rent, the cost for the staff are around 300 rupees. So, in this case, what will be the total profit? Revenue collected 500 minus different cost, I mean summation of various cost is 300 rupees. So, you have a total profit of 200 rupees. That is straightforward, right? Now, this one, the profitability metrics as mentioned here are basically tools to evaluate how well a company turns revenue into earnings. So, basically either the company has to increase the revenue or reduce the cost of operation, cost of marketing or any other expenditure associated in order to increase the profitability for the organization. These are not just the numbers on a spreadsheet, they basically guide the big decisions of an organization. In real life, companies like Apple, they use this to decide on the product launches. Let us take an instance. When Apple released the iPhone 15, they calculated the profits after deducting manufacturing and R&D costs to ensure that it is financially viable. The product is financially viable to exist in the market. So, why does this matter? Without tracking the profit, businesses can bleed money without even realizing it, and that is why it is extremely important. These are extremely important metrics to keep monitoring while you are in the business. Now, let us look at importance of profit in marketing analytics. What is profit? In a nutshell, profit is a key performance indicator for marketing efforts. It is crucial KPI. This particular slide highlights how measuring profits help the marketers gauge the financial impact of campaigns and make data driven decisions, data driven choices. Think about it. A flashy advertisement campaign might drive sales, but if the cost outweigh the revenue, then in that case it is a loss. Profitability metrics let the businesses evaluate the overall financial health of the business as a whole or the different activities associated with the business. For real life example, consider Coca-Cola's holiday campaigns. They spent millions on ads featuring Santa and the polar bears. By tracking the profit post the campaign, after implementing the campaign, revenue from the increased sales minus the cost, they decide whether the campaign was worth it or not. In 2022, their Real Magic campaign boosted sales by 7%, leading to higher profits and informed future budgets. So, unless and until you have these calculations in place, you will not be able to understand whether your business transactions are towards profitability or towards loss making. These metrics are vital for informed decisions like expanding to new markets or tweaking the product lines. Without them, you are just flying blind. Let us have a look at some of the important key profitability metrics. I will just spell out the names. Some of the metrics are already discussed in detail with examples in the last class. So, we will just reinforce this concept and we will also look into some of the advanced metrics. First key profitability metrics is the gross profit margin. Second one, operating profit margin, net profit margin. Then comes return on asset, return on equity, return on investment. Then comes earning before interest and taxes and earning before interest, taxes, depreciation and amortization. So, these first three metrics are called the core profitability metrics. So, in the last class we had detailed discussion about these three metrics. We will quickly go through this three concept and then delve more into the remaining concepts. Gross profit margin shows the percentage of revenue left after deducting the cost of goods sold. The formula is gross profit divided by revenue multiplied by 100. Gross profit margin basically tells you how efficiently you are producing the goods. So, it refers to the, it is a reflection on the operation, production efficiency of my product. For example, Nike's athletic shoes, if the revenue from a pair is $100 and COGS, that is cost of goods sold, let us say the cost of material, the cost of labor is $40, then gross profit is $60. From each pair we are getting a gross profit of $60. So, the margin, gross margin is 60%. High margins like this allow the reinvestment in branding. If the margin is like, gross margin is like 40%, 50%, 60%, it is very high. So, you have the flexibility of investing a portion of this margin in some other fruitful activities such as investment in marketing, investment in R&D, investment in innovation. So, next one is the operating profit margin. So, the formula is operating profit divided by revenue multiplied by 100. This is basically the profit from core operations before the interest and taxes. It highlights the efficiency of your operations. Starbucks, for instance, tracks to see if store operations are profitable after the rent and wages. In 2023, their operating margin was around 15%, which guided them for a expansion. So, these metrics directly guide your business decisions. Finally, let us also have a quick look at the net profit margin. Formula wise, it is net profit divided by revenue multiplied by 100. This is the bottom line after all the expenses. Tesla's net margin improved from negative in early years to over 10% now. So, what contributed to this positive impact on the net margin? It is the scaling of production, showing how EVs become profitable. These margins help benchmark against the competitors. Now, we will look into the metrics of returns. So, we will talk about three metrics of return. One is return on asset, another one is return on equity, and the third one is return on investment. So, return on asset measures the asset efficiency. Formula wise, it is net income divided by total asset multiplied by 100. Basically, it reflects how well do your factories, inventory, etc. generate the profit for your organization. Walmart excels in return on asset. So, the return on asset is close to 6 to 7%, which is excellent for a retail business. If I look at return on equity, it looks at the shareholders return rather than the return of the asset. So, the formula is net income divided by shareholders equity multiplied by 100. This is key for investors. For example, Microsoft return on equity is often over 30%, which is very good, meaning strong returns on invested capital, and this is what fuels the stock prices, stock valuation, or the sentiment in the stock market about this company. The last return matrix, that is return on investment, it evaluates the investment. Formula wise, it is net profit divided by investment cost multiplied by 100. Say you invest 1 lakh rupees in a marketing campaign which yields a additional profitability of 1,50,000. So, your ROI is 50%. You invested 1 lakh, you got an additional profit of 1,50,000. So, 1,50,000 minus 1 lakh divided by 1 lakh makes it a figure of 50%. This helps compare the investment and ensure resources are used wisely. Next, we will look into some advanced metrics. So, the first one is the EBIT, earning before interest and taxes. So, EBIT measures core operational profitability ignoring the taxes and interest. It is great for comparing the companies across borders. The taxation rules are different across different countries. For example, if you go to Middle East, we are, let's say, we are doing the same kind of operational efficiency activities, but in the Middle East, the EBIT in Middle East and EBIT in India will still remain the same, but net profitability in Middle East will be more than that is in India because of the applicable taxes. Then next comes this earning before interest, taxes, depreciation and amortization. It shows a clear view of operational profitability by excluding non-operating cost and accounting effects. It adds back it does not take into consideration this depreciation and amortization. Your EBIT does not take into account the depreciation and amortization, but in this case EBITDA, it also includes the depreciation and amortization. It adds back the depreciation and amortization for a clearer operational view. Unless and until depreciation and amortization is in place, you will not be able to actually realize what is the profit that you are getting from your operational activities in a financial year, because the equipment depreciates over a period of time. So, there will be a salvage value at some point of time. So, if you do not take that into account, then in that case your calculation is not realistic. Next one is the contribution margin. So, contribution margin formula wise, it is sales minus variable cost divided by sales into 100. This shows what covers fixed cost and profit. Let us take an example. For a bakery, if the cake sells for 20 rupees and the variable cost associated with the production and other cost, it is 8 rupees, then contribution is 60%. 20 minus 8, that is 12, 12 divided by 20, which is 60%. Contribution margin helps us decide on scaling of production, because there is also a, in the break even analysis we will also need to understand there is also a fixed cost. So, this helps us understand the scaling of production. Let us take an example, Uber's ride sharing, high contribution margins from fares minus the driver's payout allow covering the application development cost, which is a fixed cost. Now, let us dive into break even analysis. Break even analysis finds when revenue equals to cost, a situation of no profit and no loss. So, from each of these unit sale you will derive some contribution, right. So, that contribution has to compensate for the fixed cost that you have incurred. Let us say if my fixed cost is 1 lakh rupees and for per unit sale I derive 1000 rupees. Now, in order to cover that 1 lakh rupees fixed cost, I have to sell at least 100 units of my products. So, I will get a contribution margin of 1000 rupees from each of this unit, and the 100 unit will compensate for my fixed cost incurred in the business process. This one break even analysis determines the minimum sales for profitability. Unless and until I sell 100 units, I cannot think about profit. It basically evaluates the viability of a business. Let us take an example. Let us say a startup launching an app might have 50,000 rupees in terms of app development, and there is a variable cost of 5 rupees per user, let us say in terms of server cost, or let us say in terms of utility cost. So, if it is sold at 10 rupees per user, then in that case the break even will be, what will be the break even? Let us calculate. So, what did I say, that fixed cost is, app development cost is. So, let us look into this one detailed explanation of this example. So, what was the fixed cost that we incurred in terms of app development? It was 50,000 rupees. Now, from each of these units sold, I am considering the users as 1 unit sold. So, for 1 user you are getting 10 rupees, and what is the variable cost associated with each user? It is 5 rupees. So, 10 rupees minus 5 rupees means from 1 user we are deriving a profit of 5 rupees, but we have already incurred a fixed cost of 50,000. So, 50,000 divided by 5 rupees. So, we must have at least 10,000 users in our platform in order to arrive at a situation of no profit and no loss. This kind of analysis is called break even analysis. So, formula wise break even analysis can be seen like this. So, what is your contribution margin? That is, let us say 40% contribution margin, 0.4 multiplied by number of units equal to your fixed cost. So, basically your number of break even units equal to fixed cost divided by contribution margin. So, if fixed cost is 1 lakh rupees and contribution margin is 40%, then 1 lakh divided by 0.4. So, that will give you the break even point. So, you have to, in this particular example, 1 lakh divided by 0.4, it will give you 2,50,000. You have to sell 2,50,000 units in order to arrive at a situation of no loss and no profit. And if you can sell anything beyond 2,50,000, it will give you a incremental profit. So, every 5 rupees that you are getting is your profit. Basically, break even analysis is a tool for pricing and forecasting. Now, let us look at applying profit metrics in decisions. Profit metrics guide the decisions like investments, the decisions regarding pricing, decisions regarding resource allocation. For example, a company like General Electric (GE) analyzes profitability per division. What they do? They de-invest or divest low margin one like the appliances in 2021 to focus on the high ROI like aviation. So, they will always calculate this matrix from each of these product line, and they will disinvest in those product line where the profitability is lesser, and they will probably put more emphasis on those products which are more profitable. In Indian context, in e-commerce, the Flipkart uses the net margins to decide on discounting strategies during sales events, ensuring the overall profitability. So, the calculation is always there in place. It is not all these initiatives, all this marketing campaign or discount campaign that they come up with is not about gut feeling, it is backed by this kind of calculations. These are not static, that basically drive actions. So, now let us look into the strategies to enhance profitability. As I said that profitability is a function of price and cost, unit price, unit cost and quantity demanded. So, these are the three factors in place. So, what can we do to boost the profitability? One is the pricing strategies. We can do something on pricing strategies. So, one example is can be dynamic pricing like we do in airlines. So, during the heavy demand period the price of the product will go high, during the low demand period the price of the product will go down. So, basically they are optimizing on the prices, they are optimizing on the profitability. So, we can also reduce the cost to improve the profitability. So, cost reduction can be achieved by streamlining the supply chain. So, if there is all the entities involved in the supply chain is streamlined, the overall cost of the supply chain will go down. So, overall cost of production will also go down. Then we can also improve the profitability, improve the margins by improving the efficiency. So, one of the example of improving the efficiency can be applying automation. So, if we are applying more automation and less of labor, then in that case our contribution margin increases and it makes our business more financially viable than our competitors. Examples that we can look into is from western context, the Southwest Airlines cuts cost with single plan fleets, improving the margins. Another example is that IKEA reduces the cost via flat pack shipping, enhancing the overall profitability. And if I look at the famous example, Tesla's factory automation boosts the efficiency, turning their initial years they were in losses, now they are making profits. So, there is a shift. So, we have to implement all these steps for the sustainable growth of our organization. So, though we have understood the importance of measuring the margin metrics and profit metrics, it is not always very easy. From a theoretical point of view, it apparently looks like easy, but sometimes from a practical point of view, it is challenging. Let us have a look at the challenges in measuring the profitability. So, challenges might include the right metrics, which is the relevant metrics. Then the time lags may be, let us say I am investing more on the R&D. The benefits of R&D cannot be immediately realized. I am investing something on the R&D, the study is still going on, the prototype itself is not ready. So, when I will get the financial benefit probably 5 years down the line. So, that is why calculating the metrics becomes challenging. Then another this one difficulty comes in the form of measuring the intangible. Something that cannot be touched or felt, it is extremely difficult to measure. Example is brand value. What is my brand value? What is goodwill? So, these intangibles are extremely difficult to measure. Then there can be issues with the data. The data across different departments may not be compatible with each other. Then in that case, how do I standardize it and measure these metrics? And another important challenge is the external factors, the market dynamics. If there is a shift in the economic activities, if there is a shift in the income, overall disposable income, then in that case the metrics poses certain challenges. If we look at during the COVID, airlines like United faced data chaos from fluctuating demand. It was an unanticipated situation. So, every forecast probably went wrong, then making the profitability hard to measure. So, how can you measure the profitability in this in a situation where demand forecasting itself is extremely challenging? So, how can you overcome this kind of situation? By using technology for better data integration. So, if the data are not compatible among the departments, then probably we have to come up with certain tools which will standardize the data and measure the metrics in a precise way. Let us now conclude this session with a small caselet study of Amazon profitability strategy. Amazon is a well-known e-commerce company that has consistently reported profits in the recent years. All of us know that. A research paper by Chen et al. In 2020, what they did, they examined the Amazon's profitability strategy and found that the company has successfully implemented a number of initiatives to drive profitability. The background of the caselet is Amazon is a global e-commerce company that operates in multiple markets. It is probably almost everywhere, including the North America, Europe, Asia, Middle East, everywhere, Indian subcontinent, everywhere. Methods, what was the method applied by the study? They applied a mixed method approach, including the financial statement analysis and interviews with the industry expert. It was a mix of basically qualitative and quantitative methods. So, what was fetched out from the study? The study found that Amazon's profitability strategy is driven by its focus on operational efficiency, cost reduction and investment in advanced and latest technologies. What is the outcome of this study? The study found that Amazon's profitability has improved significantly in recent years, with the company's net income margin increasing from 2.3% back in 2015 to 4.3% in 2020. So, percentage increase is close to 100%, not exactly 100%, but close to 100%. So, what is the insights that we can derive from these facts? The facts about the Amazon's profitability strategy, including its focus on operational efficiency and cost reduction. So, by this time we have discussed about, in the last 3 sessions including today's session, we have discussed about the metrics of interest, the metrics of margins and the metrics of profitability. And we understood that it is extremely important to monitor and track all these metrics, otherwise you may be incurring losses even without realizing. So, with this I conclude today's session by a quote by Peter Drucker: if you can measure it, you can improve it. So, that is why the metrics of interest, metrics of margins and metrics of profitability are of extreme importance in today's dynamic business landscape. I will see you in the next class. Thank you.